The collapse of a housing market never begins with chaos. There are no sirens, no breaking glass, no crowds running through suburban streets. When housing turns, it does so politely, almost respectfully. It waits until most people are no longer paying attention. On the surface, America looks unchanged. Subdivisions stretch across the horizon just as they always have. Driveways are full. Porch lights come on at dusk. Real estate listings still glow optimistically on phone screens, filled with words like charming, prime location, and great investment. But markets do not move on language. They move on numbers. And the numbers, quietly and consistently, have begun to change. For more than a decade, Americans lived inside a single assumption: home prices rise. They may slow, they may pause, but they rise. This belief hardened after the collapse of 2008, when policymakers, banks, and homeowners absorbed a painful lesson and rebuilt the system to prevent another freefall. Lending standards tightened. Equity grew. Regulation returned. The conclusion seemed obvious. The crash was an anomaly, a once-in-a-generation mistake. Housing, it was said, had been fixed. That belief did not come from emotion. It came from data. Year after year, prices recovered. Then they surpassed their old peaks. Then they accelerated. Even during global disruption, prices surged. Demand appeared limitless. Supply appeared permanently constrained. And then something subtle happened. Prices stopped accelerating. That moment did not make headlines. It didn't trend on social media. It appeared as a rounding of curves on charts few people study closely. Appreciation slowed from double digits to single digits, then from single digits to flat. To most observers, this looked like stabilization, healthy normalization, a soft landing. But stabilization is not what the underlying numbers were showing. Because before prices ever fall, something else always falls first. Liquidity. Sales volume is the bloodstream of housing. It tells you not what sellers want, but what buyers can actually do. And long before price indices turned, volume began to dry up. Mortgage applications declined. Pending sales fell. Closings dropped. The number of people actually transacting shrank dramatically, even while prices appeared firm. This is how the illusion of stability is created. A house that does not sell does not change price. It simply waits. Multiply that waiting across millions of listings, and averages remain artificially high. But beneath the surface, pressure builds. Housing is unique among assets because it is slow and emotional. Owners do not wake up one morning and decide to sell because a chart dipped. They wait. They hope. They anchor their expectations to yesterday's peak. And so when buyers disappear, sellers stay put. At first, the catalyst for that disappearance was not fear. It was arithmetic. Mortgage rates doubled. In less than 2 years, the cost of borrowing money rose at a pace unseen in modern housing history. The same house, listed at the same price, suddenly demanded hundreds, sometimes thousands, more per month. Incomes did not rise to match. Affordability collapsed quietly, brutally, and mathematically, not as a percentage, as a lived experience. Buyers sat with loan officers and watched numbers refuse to work. This was not a loss of confidence. It was a loss of qualification. The result was predictable. Buyers vanished from the margins inward. First-time buyers disappeared first, then move-up buyers, then discretionary buyers. What remained were sellers anchored to prices set in a different interest rate world. This mismatch is where every housing downturn is born. Not in panic. In standoff. For months that standoff held. Inventory rose slowly. Days on market stretched. Sellers adjusted expectations by inches, not feet. But the numbers continued to speak. Repeat sales indices, which tracked the same homes over time, showed appreciation flattening, then slipping. This mattered more than any median price. Because when the same home sells for less, excuses vanish. Seasonality could not explain it. Inflation could not hide it. Location could not isolate it. The same asset worth less. At the same time, price cuts began spreading. At first they were small, strategic. A few $1,000s shaved off listings that sat too long, but then second cuts appeared. Third cuts, reductions large enough to matter. This was no longer marketing. It was concession. Builders noticed first. They always do. Unlike homeowners, builders cannot wait indefinitely. Their business depends on velocity. When demand slows, incentives appear. Rate buydowns, closing credits, free upgrades, discounts disguised as generosity. These incentives rarely show up in headline price data, but they represent real declines in value, quiet ones, institutional ones. Meanwhile, investors began stepping back. For years they absorbed supply, they paid cash, they ignored rates, but yields compressed while costs rose, taxes increased, insurance premiums surged, maintenance became more expensive. The math stopped working. When investors retreat, housing loses its shock absorbers. Volatility increases, demand thins. And still, to most Americans, nothing seemed wrong. Because housing downturns are not visible events, they are statistical ones. The real shift was not fear. It was alignment. Multiple indicators moving in the same direction. Volume down. Inventory up. Affordability broken. Price cuts spreading. Investor demand fatting. No single signal proves a downturn, but together they form a pattern too consistent to ignore. This is the moment markets turn, not when prices collapse, but when expectations do. An expectation once broken does not easily return. The chart does not scream. It never does. It waits until people stop looking at it. By the time a national housing index officially confirms that prices are falling, the market has already moved on. Decisions have already been made. Losses have already been absorbed, quietly, unevenly, and without ceremony. This delay is not a flaw in the data. It is the nature of housing itself. Housing data is slow because housing is slow. Sales take weeks. Closings take months. Reporting takes longer. By the time a number appears on a government release or a major index, it is describing a reality that no longer exists. This lag creates one of the most dangerous illusions in economics, the belief that stability still holds because the past has not yet admitted it is over. To understand why prices can be falling while headlines insist they are not, one must understand how housing numbers are constructed and what they leave out. The most common statistic cited is the median home price. It is simple, intuitive, and deeply misleading. The median does not track the same house over time. It merely marks the midpoint of whatever happens to sell in a given month. If fewer entry-level homes sell, the median rises even if no individual home gained value. If luxury homes pause, the median falls even if nothing became cheaper. In turning markets, composition changes faster than value. Buyers retreat from the margins inward. Lower-priced homes stop selling first. That alone can push medians up even as demand collapses. This is how falling markets hide in plain sight. Repeat sales indices tell a different story. They track the same properties across time, stripping away composition noise. When these indices flatten, the market is no longer growing. When they decline, the decline is real. That flattening has already happened. Across major metros, appreciation slowed to zero, then slipped below it. Not dramatically, not uniformly, but persistently. Month after month, small declines accumulated, too small to spark panic, too consistent to dismiss. Price cuts offer another window into reality. Listings are aspirational, reductions are confessions. A seller cuts price only after the market has already spoken and been ignored. One reduction suggests mispricing. Two suggests resistance. Three suggests surrender. In rising markets, price cuts are rare and brief. In turning markets, they spread quietly, first among overextended sellers, then among ordinary ones, then among builders. Builders are the most honest participants in housing, not because they are virtuous, but because they are exposed. Inventory costs money every day it sits unsold. When demand softens, incentives appear immediately. These incentives rarely appear in official price data. A builder may keep the sticker price unchanged while offering tens of thousands in rate buydowns and credits. On paper, prices hold. In reality, values fall. This is how downturns disguise themselves. Mortgage data reveals the stress earlier than prices ever can. Applications collapsed long before price indices moved, not because people lost interest in homes, but because homes lost affordability. Affordability is not an abstract concept. It is the line where a lender says no. When rates doubled, that line moved violently upward. Buyers who could afford a home months earlier suddenly could not, without any change in price. This created a pool of would-be buyers frozen outside the market. Frozen demand does not bid prices higher. It waits. Inventory, meanwhile, rose steadily, not explosively, slowly enough to avoid headlines, enough to matter. Days on market lengthened. Homes sat. Sellers waited. This waiting period is critical. It is the psychological buffer between peak confidence and acceptance. Markets do not fall until sellers accept that yesterday's price is gone. That acceptance takes time. Investor behavior adds another layer of confirmation. During the boom, investors were insensitive to rates. They cared about yield, appreciation, and liquidity. When those metrics deteriorated, they stepped back. This retreat did not make news. It showed up as fewer cash offers, fewer bidding wars, fewer shock absorbers. When investors leave, owner-occupiers set prices, and owner-occupiers are constrained by income. Income did not double. Insurance costs rose. Property taxes adjusted upward based on past valuations. Maintenance costs increased. The total cost of ownership climbed even as appreciation stalled. This is how pressure accumulates without panic. Employment, too, plays its role, not through collapse but through uncertainty. Housing does not need mass unemployment to weaken. It needs buyers to hesitate. It needs households to delay. It needs confidence to erode just enough. That erosion has begun. Demographics quietly reinforce it. Aging homeowners begin to unlock equity. Downsizing becomes practical. Estates liquidate. Supply increases without drama. At the same time, younger households struggle to enter. The traditional chain of first-time buyer to move-up buyer to seller weakens. When chains break, volume collapses. Volume collapsed first. Prices follow last. This sequencing is not new. It appears in every housing downturn. What changes is the excuse used to deny it. This time the excuse is resilience, strong balance sheets, high equity, better lending standards. All of these are true and irrelevant to direction. They determine how a downturn unfolds, not whether it exists. Prices do not need to collapse to fall. They need only lose the support of expectation. That support is gone. The data does not shout because it does not need to. It aligns. And alignment is more powerful than any single statistic. By the time consensus agrees with the numbers, the opportunity to prepare has already passed. The first sign is not a foreclosure notice. It is a calculation done late at night, at a kitchen table with the lights turned low, when someone realizes the numbers no longer work. Housing does not unravel through spectacle. It unravels through pressure. Pressure applied slowly enough that it feels manageable until it is. By the time prices begin to fall in a visible way, households have already been adjusting for months. They cut spending. They delay repairs. They stop talking about upgrades. They tell themselves the market will turn back soon because markets always have before. This time the pressure is different in form, but familiar in effect. Mortgage rates change the structure of ownership. Millions of homeowners locked in historically low rates. On paper, this should create stability. In practice, it creates immobility. People cannot move without doubling their payment. This traps supply and freezes demand at the same time. Frozen markets feel stable. They are not. For those who bought near the peak, the situation is more fragile. Adjustable rate mortgages reset. Temporary buy-downs expire. Payments rise quietly, predictably, on schedules no one talks about publicly. These increases do not cause panic. They cause budgeting. At the same time, costs unrelated to the mortgage surge. Insurance premiums climb, driven by climate risk, reconstruction costs, and shrinking insurer participation. Property taxes recalibrate upward, reflecting past valuations rather than present realities. Maintenance grows more expensive as labor and materials rise. Owning a home becomes heavier, even if its price does not change. For years, rising values masked these costs. Appreciation acted as psychological relief. Equity growth made pain feel temporary, but when prices stall, that relief disappears. This is where behavior changes. Homeowners stop thinking of their home as an asset that rescues them and start thinking of it as an obligation that binds them. That shift is subtle but profound. Selling becomes imaginable, not because of fear but because of fatigue. Life does not pause for markets. Divorce happens, health declines, children leave, parents age. These events do not wait for price recoveries. They create forced decisions. When forced decisions meet a market with limited demand, prices adjust. This is why downturns accelerate after long plateaus. The plateau is not stability, it is compression. Job markets add another layer of stress, not through collapse but through selectivity. Layoffs do not spread evenly. They appear in clusters, technology first, finance next, construction follows demand. Housing does not require mass unemployment to weaken. It requires enough uncertainty that buyers hesitate and sellers lose patience. That hesitation spreads quietly, a promotion delayed, a bonus reduced, a contract not renewed. Each event removes one buyer from the market. Multiply that across millions of households, and demand thins without drama. Demographics amplify the effect. A large cohort of homeowners approaches retirement age. Many hold substantial equity, but also fixed incomes. Rising taxes and insurance hit them harder. Downsizing shifts from desire to necessity. These sales are not speculative, they are inevitable. At the same time, younger households face an entry barrier defined not by desire but by mathematics. High rents prevent saving. High rates prevent qualifying. The traditional ladder breaks. Housing is not a collection of independent transactions. It is a chain. When the first link weakens, stress travels upward. First-time buyers vanish. Move-up buyers pause. Sellers wait. Then sell. Investor dynamics reinforce the shift. During the expansion, investors absorbed volatility. They smoothed declines. They bought when others hesitated. Now, higher financing costs and lower yields remove that support. When investors leave, price discovery returns, and price discovery is rarely kind. This is not a story of collapse, it is a story of gravity. Prices do not fall because people panic. They fall because carrying costs exceed comfort, because opportunity costs rise, because time erodes optimism. Most homeowners will not sell at a loss. They will sell at a concession, then another, then another. Markets move not on extremes, but on margins. A small percentage of sellers lowering prices is enough to reset comparables. Appraisals follow, lenders adjust, buyers anchor lower. Once that cycle begins, it does not reverse quickly. The defining feature of this phase is denial, not emotional denial but statistical denial. National averages lag reality. Headlines speak of resilience. Individual markets soften quietly. This is how turning points hide. Pressure does not announce itself. It accumulates, and when it reaches a threshold, movement follows. Not violently, inevitably.